Why waste any time planning about your taxes or worrying about your taxes? Heck, you're making money anyway. Does that make any sense? Of course it doesn't. Is that the kind of advice we give at Checky Financial? No, not at all. What we do is we say, look, would it be okay with you if you kept more money, did it all legally in advance, and reduced your tax bill? Is that of interest to you? And JJ, have you ever had a client say, nope, I'd rather pay as much taxes as I can?
Doesn't come up often.
In my point of view, from the 50 years I've been a CPA, I have not heard that. Actually, I did hear it once. I did hear it once from a client who said, nope, I do not want to buy that post-tax, accumulate, tax deferred, get money out tax-free, which is a fancy way of talking about universal life insurance. And they said, we just like to pay our fair share.
That's the story I remembered, actually, which, as I said, not often.
And they literally worked for a public radio station. And public radio stations can do everything and occasionally even have a balanced point of view, but it seems to be a more liberal point of view or a progressive point of view. Not that there's anything wrong with that. It's just that we like to think from all sides of the aisle, all parts of the silos, all parts of tax law, so that you can actually have fun and still have money and actually enjoy the journey without getting audited, if at all humanly possible. So, a sad story. A client who's since died and gone to heaven came to me after he had retired, after he had applied for Social Security, but before he had reached full retirement age. What are the consequences? JJ, why don't you explain the consequences of starting your life, starting that, and making a lot of money at the same time to getting your goodbye bonus?
Yes, there's a few different things, or two particular things. One, you get a reduced amount of Social Security because you're not full retirement age. But on top of that, if you make more than a certain amount, which is a fairly small number, you actually then have to give it back, a portion of it.
And are people normally happy about that?
No, they definitely want to prepare for that, or not prepare for that, but actually plan intentional about the timing of the Social Security, not an oops after the fact.
I had another client who refused to meet because it was an inherited client. And JJ, why don't you tell us what the heck an inherited client is?
Their current advisor, maybe they pass away or leave the business, so it's the client or accounts are given to another advisor to take care of them.
This lady didn't really understand what her investments were, also refused to come in and talk, which is one of those, okay. Then one day I did get a call from her, and she was at a bank, and she had an annuity, which is a tax-deferred contract between the investor and an insurance company. It was a non-qualified annuity. And JJ, tell us what a non-qualified annuity is.
So taxes have been paid on the money before it went into the investment. Or not tax deferred is another way to say it.
And if that had been bought after 1984, it comes out income first. And defining that in everyday language, let's see if we can get this coffee cup in here. Yes, we can. Let's say you filled up that coffee cup, half full, actually 3/4 full, with whatever beverage you enjoy. And then it accumulated where it now is a full cup of coffee. When you take a sip of that coffee, it would come out income first. And today, tell us what the heck that means.
It means you're taxed on your initial gains. So you gain, your investment appreciates, it goes up in value, and the first portion, which is the increase, is taxed to you.
And when you cash in an entire annuity in one fell swoop, do you get to pay capital gains on that, which is a lower tax rate, or do you pay ordinary income tax on that?
You get to pay ordinary income and a potential penalty.
And this lady called after she had talked into cashing in the annuity at a bank with no particular advice in advance. And I said, ma'am, have you already cashed that in? She said, yes, I did. How can I not get taxed on that? I said, well, If you had called me before you had done that, I could have given you some advice to avoid that, whether it be rolling it over into one of their annuities or just keeping it and taking money out on a gradual basis. But right now, ma'am, all I can say is I'm so sorry you didn't come in to talk to us. So, the takeaway on all discussions with financial advisors can be summarized in: give us a call along with your CPA a call, listen with an open mind, do the math, maybe even pull out a calculator or your magic telephone, which has a calculator in it, and decide if you really want to pay the income tax that could have been deferred. In addition to that, just the other day, went to a workshop on the subject of tax diversification. JJ, tell us what the heck that means.
Tax diversification is spreading out your investments into post-tax taxes you've already paid, or excuse me, an investment you've already paid the tax, and pre-tax that you haven't been taxed yet, particularly on your income.
And pre-tax normally is an IRA, if you're eligible for an IRA, or a 401k, if you're eligible for a 401k, and you get a tax deduction. And it is wonderful. I advised all my kids, especially when they had jobs with other people that had 401ks, to go ahead and put in at least a couple of percent, if not the matched percent. Matched percent commonly is, oh, you put in 6% of your pay and they give you 3% of your pay for free. So immediately you've gotten a tremendous return on your investment. It takes a couple of years to vest in that. What the heck does vest in that mean, JJ?
When you work for a company, each year the money becomes yours. So year one, it's maybe 20%. Year two, it's 40, and then it goes on to you've worked for the company long enough that they say how much the company put in on your behalf is now 100% yours.
It is that simple, unless you forget it. And when you forget it, and you, for whatever reason, separate from service from a particular company before you have reached the vesting period, holy guacamole, that money that you thought was going to be yours turned out not to be yours. In fact, funny story on that particular subject. I had a wonderful client who is still a client to this day. We've taken him through his work experience to retirement. Just an open conversation, just having a nice casual conversation, seemingly. He said, oh, if I stay another year there, I'll be fully vested in my pension. And his darling wife and I both said, pension? What pension? Because he had forgotten to tell us, even though we keep asking people, please disclose all your information. Send us your horse blanket that they give you. A horse blanket used to be an expression that human resources, back when they had the human resources department, also were in charge of the pension, 401k, and a bunch of other stuff, which gave everybody a headache because nobody can do all that in one office without a whole bunch of expertise and supplements of expertise. And we asked him to get a printout of what that is, just for fun. Well, it turned out when he finally did retire about 15 years later, that was worth just about $1 million. And JJ and I put together a plan of action in terms of how to properly do that. So he didn't owe any taxes until he started yanking money out of the pension. And there's no real way to escape that I'm aware of. Have a nice day. If you know of a way to do that, please let us know. We would love to know a way to take tax-deferred stuff and not pay any taxes on it whatsoever. And I've heard any number of financial advisors claim that they did that. And I said, look, as a certified public accountant for 50 years, I'm always doing research. I would love to see how you did that. And I'd like to see the private letter ruling you got on that from the Internal Revenue Service. I'd like to see the case law when that was defended. And I'd like to make sure you've done that for at least 3 years so that the cases have actually been settled. And that may sound kind of pedantic, but it's awfully nice to be sure what you're telling somebody is actually a true statement. DJ, have you ever taken over a case after somebody else forgot to mention some details to their client?
Yes, I have. I've definitely seen where someone maybe, I'll call it a misstep along the way, that they were given either poor advice or maybe even didn't take the advice they were given that would have helped them financially, would have helped them as far as the tax goes, and may have made it a smoother ride for them and their family as well.
So
A
we're
moment ago, we mentioned tax diversification. One piece we didn't talk about, or kind of didn't spend as much time on, is why not put all your investments into a tax deferred account? What are your thoughts on that, John?
as much fun as that is on the front end. It's not nearly as much fun on the back end. In fact, I'll tell you a quick story on that. I have a client who's been a client for about 20 something years. His wife is now deceased, had been a client for a little bit before that. And almost, he said, John, I have 1 point, whatever it was, $1 million. And I'm just trying to buy a house for $500,000. And I don't seem to have the ability to get a line of credit on that. And I said, well, you can't really hawk your IRA. What I mean by that is considered an immediate distribution of all the proceeds in the IRA and it becomes immediately taxable. Side effect is one, you pay a lot of taxes. Two, your Medicare premiums go up. And you think, oh, that sounds like a bad idea. I said, yes. That's one of the reasons we suggested to people over the years to not have all your eggs in one proverbial basket unless you really watch that basket like crazy. You don't mind paying a bunch of tax later on in life. So almost everybody, once they reach the required minimum distribution age, and I was one of them too, takes a deep breath, because I can't believe I have to take this money out of my IRA. And I don't want the money out of my IRA. What the heck am I going to do with that? So, well, you can take it from your IRA brokerage account and put it in your non-qualified brokerage account and pay the income tax. Is there any way around that? Yeah, you can actually donate the money to a charity called a QDC, qualified
UCD, yep.
Distribution. And there's some forms to fill out and what have you. You have to be really careful because getting the paperwork really straight is a good idea. Making sure the charity or church or whatever it is you're donating the money to books it properly and gives you credit for it and knows it was your money that they received, not just some magical gift from God. We are the co-founders of Checky Financial, and we help people have fun and still have money. If that sounds good to you and you appreciate paying less taxes rather than more taxes, please consider giving us a call if you're coachable. If you're not coachable, I'm sorry. There's not much of anything we can do that your mom didn't already try to do with you.
Have fun. Make it a great day.
Bye.